Hello, everyone. Welcome to the Defiant weekly recap, the first week of 2023. Happy New Year. My name is Ed Robinson. I'm a contributing editor at the Defiant, and I'm joined today, as ever, by our illustrious crew, YYC Trader, news director for the Defiant, staff writer Owen Furnow out in San Francisco, Alex Gilbert in good old New York. Welcome all. It was a pretty heavy first week, and it was kind of a tale of two stories, I would say, if I may. We had some really interesting surprises this week on the market front, but we also had a ratcheting up of the crypto crackdown on a few different fronts. And we'll get to that stuff a little later. But first, the action in the markets. We saw a broad rally in cryptocurrencies and especially in DeFi. Ethereum, according to the Defiant terminal, Ethereum was up over 5% in the last 7 days. Other DeFi names had double-digit increases or more. We saw Uniswap up almost 8%. Avalanche headed towards 6%. It just kind of went on. It was a most welcome respite after a pretty brutal fourth quarter in which I think a lot of crypto investors and DeFi investors as well were, asking some rather existential questions about what was going to happen in 2023 in the wake of the FTX disaster and just this grinding bear market. So the performance this week of these tokens is quite a surprise. And YYC, can you just unpack this a bit for us? I mean, what happened this week? Why was the market up?
Sure. It's a new year. Investors were anxious to close the book on 2022, I think. And of course, there's some effect from tax loss selling that we see every year in December. Obviously, in a year like 2022, people ended up with a lot of losses, right? So it's only natural that they would sell some of those assets to book those losses for tax purposes, either to reduce their tax bill for 2022 or carry forward these capital losses to offset future gains, right? So we saw this, like you said, the major tokens are up. ETH is up about 6% in the week. Bitcoin a bit more muted at 3%, but in DeFi. Specifically, we're seeing the liquid staking narrative pick up, especially now that the Shanghai upgrade for Ethereum is scheduled for March, tentatively. So what that means is that all the staked ETH that couldn't be withdrawn until now users will have the option to withdraw their stake tokens. Not all at once, because there is like a withdrawal queue and whatnot. But I think this is positive.
Well, what effect will that those withdrawals have on ETH in the market?
I mean, it depends on how. It's impossible to predict how many people will choose to unstake their ETH when the upgrade comes around. I mean, we still have 2-3 months to go till that happens, right? And it'll all depend on like sentiment and where the market is before it happens, I think. But in terms of liquid staking tokens, this removes a lot of uncertainty around them holding their peg, etc. Because one of the main concerns has been, how the lack of an arbitrage opportunity due to the lack of withdrawals. So that's something that's going to be addressed with Shanghai. And I think that's the reason why we're seeing this uptick in liquid staking protocols, because they'll finally be able to start making money, right? Because once the full transaction circle, if you want to call it that, is opened up, right? Because so far it's just been one way. You can only like kind of stake your tokens and then you take your LSDs and then use them in DeFi and whatnot.
Right. Okay. What about the correlation between stocks and tokens? That was such a big story last year. Is that continuing in the first week?
Kind of. There was some sort of decoupling, if you can call it that, over the week, because crypto was relatively stable, even though stocks were all over the place. Like we had like 1% moves on almost every day this week. Right? Like today, major stock markets in the US are up 2% on the back of the jobs report that came out this morning. And even though the actual report was good and came in ahead of expectations, I think markets are just kind of pricing in what it means for Fed policy going forward. So there was a softening in wages. So even though like the economy added jobs, like people are getting paid less. So from an inflation perspective, you could say that, okay, since people have less money to spend, this should be net negative for the economy, right? And that, I think that's one of the reasons why markets are rallying strongly. And another reason just being we saw so much selling in December, it was like a bounce was due.
Yeah,
right?
I guess that happens.
Yeah.
Alex, you wanted to say something. I'm sorry. I think you were going to make a point.
Just that the YYC pointed out the one-way nature of liquid staking protocols so far. I just quipped that it reminds me of GBTC.
How so?
You put the money in, you put the crypto in, and you don't get to take it back out. So the arbitrage isn't quite there yet. The future seems a lot brighter for liquid staking tokens, though. I should be very clear about that.
Ah, interesting point. Okay.
And what is, like Alex, you're our liquid staking aficionado, so I unfortunately, they're still like somewhat mystical to me. So like once Shanghai happens, I mean, what's going on? Are they trading? I know it maybe depends on the token. Are they trading 1-to-1 with Ethereum? And like, how does it accrue yield if that's happening? Could you maybe shed some light on that? I don't mean to put you on the spot, but.
No, put him on the spot. It's all right.
All right, you're on the spot.
That's what we do to other people, not what we do to each other.
I'm doing it to you live, man.
Yeah. Well, so the derivative tokens like Lido's staked ETH would be redeemable for Ether, right? So they in that sense they would trade 1-to-1 because you could just cash in each ST ETH token for regular ETH.
Right.
As far as how they generate yield, I mean, each derivative token has a different way of routing staking yields to customers, but it all comes from the fact that when you stake Ether, just the way Ethereum now works under proof of stake, emissions accrue to stakers, and are of course more burned through blockchain activity, which is why it's supposed to be high percent money, but that's the general idea.
Okay, that helps with intuition.
I study political science, man. I don't ask me so many technical questions, or you're gonna.
No, I apologize. You can hit back later in the show. No worries.
Yeah, I'm sure he will.
I mean, I think Alex pretty much nailed it in terms of the explanation. Like, because you're opening up the one-way street to become a two-way street, there's no reason why the LSD shouldn't trade 1-to-1 with ETH. Mm-hmm. So regardless of the amount of, like, let's say, for example, right now, without the withdrawal option, like what we saw with 3AC and Celsius dumping staked ETH over the summer, right? And at that time, it was peak FUD because no one wanted to just step in and like support the price of staked ETH, right?
Right.
But if staked ETH was redeemable for ETH 1-to-1, you'd see people pouring in to buy and close that discount, right? That's the arbitrage.
Yeah, you'd be a fool not to, because that's just free money.
Yeah. So this would completely change the dynamic in terms of liquidity, etc. Because Lido and other providers wouldn't have to necessarily incentivize liquidity for their tokens then, because there would be profitable arbitrage opportunities for traders to close that gap themselves. So they might end up spending less on like liquidity incentives and stuff down the road.
That's interesting. I wonder, do you think that's maybe part of why Lido's token is pumping? I mean, if less emissions, conceivably, you could say. leads
potentially
to a
that,
higher
and
price.
finally the chance to get some revenue share or like profit share. Right? I'm not exactly 100% sure of how the model works, but I think there is like a minting and redeeming fee or something
Sure.
that is
Sure,
built
sure.
into it, right? So that hasn't really taken effect so far. Again, need to confirm this because things might have changed since the last time I looked at the docs.
Sure, sure.
But apart from LSDs, we had Solana and Bonk, right? So Solana's up nearly 40%, more actually, 44% this week, and purely on the back of this new meme coin that came out and it's kind of rallied the ecosystem after all the bad news they've had. So I'll turn it over to Owen to talk about that since he just covered that yesterday.
Sure. Yeah. So, I mean, I'm not sure if it's all on Bonk. I mean, I assume so. I mean, and for those who don't know, Bonk is, yet another canine-related meme coin, which was deployed on Solana and
What dog breed is that?
I never had a dog. I don't know. I guess I'm going to embarrass myself. Inu just means dog in Japanese, so I don't know.
Okay.
Anyways, it is a dog, and So Bonk got a lot of attention. I think it was up, hundreds of percents at various points. There's so many zeros on that thing. I don't even know how many it lost, but I think it went up. Yeah, it's up like over almost 2,000% since December 29th. So that obviously drew some attention. Picked up various people in tweets and what have you. And so that did draw some attention to Solana, I would assume, and people would have to familiarize themselves with the blockchain in order to buy it, presumably. So that happened. I talked a little bit with Austin Federa, who's the head of strategy and communications at the Solana Foundation. And, he just said, it's exciting. People are having fun. That hasn't happened too often recently. And Solana has also been associated with Sam Bankman-Fried and Alameda and FTX because Sam has, appeared on podcasts with Solana's founder, and Alameda has invested, I believe, in a lot of the kind of ecosystems around Solana, ecosystem tokens. So I think Solana is kind of going through this period where it needs to distance itself from FTX. So the price action is interesting because it's like, well, maybe they're going to be able to do it. And they picked up if not an endorsement, a supportive tweet from Vitalik Buterin, co-founder of Ethereum, saying that that he thought some of the Solana devs were earnest builders, so they're not trying to just pump and dump, which was important to get that tweet.
No, that was a pretty newsy shout out there, to a blockchain network that was long billed as an Ethereum killer for whatever that's worth.
Yeah.
But still, Vitalik kind of reaching out is, that's interesting.
Totally. Yeah. So it'll be interesting to see. I haven't checked how like the Solana ecosystem tokens are doing, and those are the ones kind of accused of the low float, high FDV, kind of, some people would call it a scam. But high level, interesting to see some build up for Solana, and it'll be very interesting to see if they can, maintain momentum. It'll be an interesting year for sure. So
that's the question, is like, is this just a fluke that's gonna peter out really fast because it's a meme coin, or is Solana finally shaking off some of the fallout from its closeness to FTX in the which was revealed in the fourth quarter? No, good story. Shifting out of the market surprise part of the week, there was a lot of fire and brimstone on the cryptocurrency crackdown front that occurred. But I think one of the more, again, this was surprising as well, was, this blistering open letter that Cameron Winklevoss wrote to Barry Silbert, the CEO of DCG, which also runs Genesis Trading. Cameron Winklevoss and his brother Tyler, of course, are the co-founders of Gemini, the CeFi exchange. And these guys are just going mano a mano. Again, FTX fallout is at the heart of the dispute. But Cameron, in his letter, was essentially saying, we need a deal to make Gemini customers whole. They have 900 million in exposure to Genesis, and they really want some kind of plan for how those Gemini customers are going to be made whole. And Cameron was accusing Silbert and DCG of dragging their feet over that, but he didn't stop there, did he? Alex, you've covered Grayscale, which is one of the DCG companies in the past, and our colleague Sam Haig actually wrote this story. Sam, being in Australia, is probably sound asleep right now. But Alex, what can you share with us in terms of just how extraordinary this conflict was, and what happens next?
Yeah, it's surprising to see somebody, to see two people who are ostensibly on the same team go at it like this.
Right.
The Cameron Winklevoss is really, just accusing Barry Silbert of acting in bad faith, of not being a productive, partner in trying to figure out how to move forward, and it's like kind of threatened to almost out him for things that he seems to claim to know, right?
Yeah.
So he's accusing Silbert and DCG of having taken a page out of the alleged SBF playbook, accusing DCG of having commingled user funds to make risky investments across their products, right? DCG is just an umbrella company that happens to own Genesis, Grayscale,
Right.
CoinDesk as well.
Right.
And he gave Barry Silbert January 8th, Sunday as a deadline to put forward some kind of solution here. What happens should they cross January 8th without any kind of concrete proposal from Silbert? I don't know, but Winklevoss seems to think that there was actual malfeasance there, that he's
certainly suggesting that. Yeah, he's certainly suggesting that, and Silbert has kind of kept cool under all of this fire, which is pretty interesting. But at the heart of the matter, it's essentially that after FTX went down, Genesis had to basically stop withdrawals. It had to husband all of its capital to protect itself, and as part of that, 900 mil owed to Gemini customers was frozen. So now that Winklevoss is taking all sorts of heat from his own customers, and so he needs to turn around and give them some sense of relief that they're doing something. Meanwhile,
in fact, I think that
lawsuits are already being filed in all of this. But what's striking is that you have these two figures, which are, they had careers pre-crypto. These guys have been working in the capital markets in some way, shape, or form for quite a while. They both fell in love with crypto. They both become very high-profile evangelists for crypto and have built significant businesses on these. And both of those businesses are predicated on taking crypto to the masses and to Wall Street. Grayscale is a very institutional investor-focused offering. Grayscale itself is on pretty shaky ground. Alex, you wrote a story late last year talking about how they were like, we need to convert GBTC to an ETF, or we're going to have to tender shares of the trust back to customers, which is a pretty radical move. So, the pressures just cranked to 11 inside both of these outfits. And now you've got these two very high profile figures clashing over what to do. And and it's all it all kind of traces back to SBF and FTX Contagion, right?
Yeah. Just an additional piece of color. I think this broke yesterday that DCG just shut down its 3.5 billion wealth management division, which
That's right.
Yeah, which started I think only last year, so it doesn't necessarily have the same high profile that a Grayscale or Genesis does, but
Yeah,
just
More
momentum
sign of
is
trouble.
building. Yeah, for sure.
and I think that's the upshot. If there's a moral to the story, it's that the contagion that has long been associated with Wall Street. When debt craters somewhere, it creates a domino effect, and it'll just blow through counterparties. We see the same thing now in, well, I'll say CeFi, because these are CeFi entities. And it's the same thing is happening, and ultimately this all comes down to a matter of collateral and litigation. But yeah, I mean, January 8th, I mean, Cameron set this deadline. Do we have any sense of what's going to happen if Silbert ignores that deadline? I mean, I don't.
I mean, I don't actually. I don't.
Yeah.
I don't know what happens in that case. It'll be interesting to see whether Barry Silbert calls his bluff, right?
Yeah.
Because that's what's happening. They're trying to force a resolution that Silbert doesn't seem ready to commit to.
Yeah, but just to kind of round off this particular story, Cameron saying that DCG was, quote, beyond commingled. Those are fighting words, right? I mean, that's because that just immediately evokes Alameda and FTX. And Winklevoss is a smart guy. He's not doing that by accident. So yikes. Wow.
Yeah.
We'll
keep
watching this.
With SBF going through what he's going through. I mean, yeah, it's not casual.
Right. Yeah. So that was kind of a big one. And then Alex, you also, you covered the latest on the SBF case. He was arraigned this week. But I think the more interesting things for our readers was what happened with the underwriters of his bail bond. Can you share with us the details on that?
Yeah, and I'll also apologize for the radiator in my apartment. It's going off right now. There was some confusion when SBF made bail. It was $250 million. Where did he get that money from? It was secured in part by his parents, who put up their house, which, if I remember correctly, it's about $4 million, right? So it's you're getting there, but it's not $250 million just yet. But it was done with his parents and two unnamed sureties. I hope I'm pronouncing that word right. That's like the technical term for other people who are helping him put up the bond, right? So those people still have yet to be named, and in fact, when it comes time to actually sign the bond that they're putting up, they haven't, they have now, but as of earlier this week, they hadn't. SBF's lawyers had requested of the judge presiding over the case that he redact the names of these people on the bonds they sign and kind of bar the government from sharing their names. The idea being that once his parents had put up their house, I guess anybody who's associated with him now is probably going to get a whole lot of hate from the cryptoverse, right? His parents were harassed, threatened, etc. And the lawyers were basically saying, hey, these people have nothing to do with what happened at FTX. They just want to help out their friend SBF, spare them the harassment and the threats that they are sure to receive should their names become public.
Yeah.
And the judge granted that request, although the judge also noted that challenges to the request would be welcome. right? So I know that
Right.
one reporter has already put in a challenge requesting that these names be unsealed. And obviously everybody wants to know who these people are who are willing to put up, however much money the government is asking in order to secure his house arrest.
Indeed. Right. The Alex, you also covered another interesting wrinkle in the overall regulatory story, which is that New York State authorities have now joined the feds in making cases against, again, the two entities involved here are CeFi entities. We saw the New York State Attorney General sue Celsius former CEO Alex Mashinsky, alleging that he defrauded customers. And that came a day after the New York Department of Financial Services, which is the bank regulator in New York State, reached a settlement with Coinbase, in which Coinbase paid $50 million penalty and agreed to spend $50 million on compliance. I gather that was related to KYC AML stuff. Is that right, Alex?
Yeah, it is. So basically the New York's financial regulators, and just like as a little bit of background, New York is maybe uniquely, depends on your perspective, either hostile to crypto or protective of retail investors, right? But either way, it's a tough place to do crypto business. Which
that's a good point, because New York, wasn't New York State the first state that they were to require a license for Bitcoin mining, or was it mining? Or was it
requires a
license Bitcoin distribution?
So like, I'm a New Yorker, right? I
remember that.
Like I've got like 5 exchanges that are available to me to buy crypto from, which it's my understanding that that's not how it works basically everywhere else. People are spoiled for choice elsewhere, but in New York you have to have a quote unquote bit license, and not too many exchanges have actually gone through the trouble of getting one. I think like Crackdown, Coinbase, Gemini are the big ones that come to mind. But and also you mentioned mining. Don't quote me on this. I think there's some kind of moratorium in place now in crypto mining in the state of New York.
Yeah, that's more kind of in a climate change emissions context. But
Sure.
but New York State has always been, because Wall Street is there, it's New York State officials have long been quite aggressive in regulating all manners of finance. So it's not a surprise that this would happen. But one of the upshots is that there's this competition, this intramural competition between Albany and Washington. So if Albany starts making moves on stuff, it just kind of lights a fire under the guys in Washington at SEC, CFTC, Justice, Treasury, etc. And so they'll just be emboldened to make more cases themselves because they don't want to be showed up by New York State. So that's a dynamic that you could see unfolding.
Sure. And so in this case, Coinbase, the New York State Department of Financial Services flagged Coinbase for not having adequate, compliance AML type checks in place, and Coinbase said, "Okay, yeah, we'll fix it." According to the regulators, Coinbase then did not fix it, and actually, it was growing so fast in 2021 that it was accruing this massive backlog of like red flags, right? So as people would sign up for Coinbase, their internal system, even though it was, in the eyes of regulators inadequate, the internal system would flag people who seemed suspicious, who, the compliance team at Coinbase would typically then, follow up with and make sure that they should be on the platform or what have you. The backlog at one point grew to more than 100,000 customers who had signed up through Coinbase. And one example given in the order that was released this week was that somebody who had been accused of handling or distributing child pornography back in the 90s, had signed up for Coinbase, and then was, there were suspicious transactions going through their account, and it took Coinbase 2 years to even realize that, this person was doing suspicious stuff on their platform, and flag them and shut them down. So that's the crux of the issue there. The agreement that they reached was that $50 million would be spent as a penalty, and another $50 million would be spent in order to bolster their compliance program.
Yeah. Well, the thing is there's so much RegTech compliance software, state-of-the-art stuff that's now available. I mean, real, like, just turnkey solutions that banks and other financial institutions can buy and implement. A company like Coinbase, I mean, regulators just aren't going to have any patience if they're dragging their feet on implementing that kind of stuff, because it's all there. It's all, you can, automate red flags. Then you have a compliance team of human beings that will actually chase stuff down. And as long as financial institutions show good faith efforts to act on those red flags, they're not going to get hit with fines like this. So this is kind of I suppose it's a growing pain, a $50 million or $100 million growing pain for the likes of Coinbase. But I think the bigger message here is, to the industry, is time to grow up. You're gonna, whether you like it or not, you're gonna have to implement the same stuff that banks do, or securities brokerage firms, etc. And it's interesting to watch how Brian Armstrong's message, you remember, like, in 2021, he kind of struck a defiant note when it came to regulators. He was complaining, I think, back in the spring about, the SEC wouldn't talk to him or wouldn't meet with him, and he was kind of saber rattling. And but in the fall, he made some far more conscientious comments and remarks about the reality of regulation and the need for regulation, and he said, it really should be focused on CeFi entities, and he said, there really should be a carve out for DeFi, because smart contracts address so much of the regulatory needs in these outfits. And I think that's going to be really cutting edge in the year to come. And something that you guys will be writing about in the year to come is how will regulators get comfortable with smart contracts and their ability to automatically provide whatever KYC, AML, other satisfactions regulators need without using the traditional compliance structures that are in place. And, that we don't know. I mean, that's I think that's going to be a really fascinating story and a deeply important story for DeFi.
Yeah. And then you'd also mentioned Alex Mashinsky. So the New York State Attorney General is suing him for, as you mentioned, defrauding customers. Mm-hmm. The reason being that, Celsius was offering yield as high as 17% on customer crypto deposits, mm-hmm. and saying, we generate this yield by lending to, like, great, solid institutional players. It's all very safe. The Attorney General's office is alleging that he was lying about that they couldn't generate the returns necessary to pay out the yields that they had promised to their customers, and right. eventually turned to much riskier investments that didn't pay off. Hence the bankruptcy that they filed in July, right?
Okay.
So and Mashinsky is the only named defendant in that suit. If I remember correctly, it's not actually Celsius, the company.
Yeah. Before we move on, I'd just like to kind of give a shout out to you guys and to our colleague Sam Haig in Australia, who all of you did a really bang up job on producing a whole series of stories at the end of the year. We look back at all of the trends and people and just the biggest stories of the year last year, and selected those that were really important and that we wanted to flag to our readers. And I'm just going to share this on our site right now. If you want to see these stories, please go to our website and check them out, and you'll see DeFi 2022. We had a Defier of the Year that we named. Our first Defier was Zach XBT. And we did this by going out on Twitter and asking the community, who is the Defier of the Year? And I think it's safe to say, guys, right, we were kind of blown away when all of you came back and selected Zach, because Zach he's a sleuth. He's a guy who's kind of out there digging through a lot of on-chain data, looking for, bad stuff that's going on and sounding warnings for the DeFi community, which was deeply grateful. Alex, you did a really nice piece. You talked to Zach about this very important service, and he does this in his spare time, right? I mean, this is like he's got a day job. He's just kind of doing this for the
and guessed that he's putting in about 50 to 60 hours a week doing his
it's insane.
Crypto forensic work, which is just that's too much for a full-time job. Yeah.
Yeah. Well, I just want to give a huge shout out to the community, to all of you out there who said, hey, this guy, he's the Defier of the Year. Because there's a lot. I mean, there's founders you can go with. There's entrepreneurs. I thought maybe somebody would pick a rogue. Like SBF would be Defier of the Year. Speaking of rogues, we actually did have that story, of course, as well. Alex, you did a rundown of all of the various miscreants and the damage that they did. But I'd also just like to highlight Owen's piece on the breakthrough of the year. There was a lot of innovation going on last year, despite all of the fire and brimstone in the headlines. And Chicken Bonds, which has got to be like one of the great brand names in DeFi ever. I mean, it's got a ring to it, doesn't it? And it's a pretty complicated mechanism. But Owen, you kind of rolled up your sleeves and dug into these product, this new liquidity mechanism, and had covered it through the year. And what do you think is going to happen with this year?
Context for what it's worth. I think I wrote that during a blackout, or it was like at a roadhouse in Washington while like the Seahawks lost.
I'm glad they lost.
Added some color. Anyways, and all these guys were glaring at me as I was like the only dude in a laptop in a bar. It was horrible. But anyways, so I think the big thing is that they are equipped to roll out the mechanism for not only themselves but other protocols. So I think that is the exciting thing, is that, and for context, turn on the thinking cap, but Chicken Bonds basically is a way for people to deposit a given asset, and it slowly starts to accrue yield through some kind of boosted mechanism. In the case of Liquidity, which developed the protocol, it comes from something called the stability pool. And so people can basically opt in or opt out at any time. If they opt out, they get back their principal. If they opt in, they get their principal plus they get the yield accrued. And at a certain point, the yield accrued is going to exceed that of their principal.
Okay.
It's a bit complicated, and I probably shouldn't get into the weeds for
readers, if you're interested, check out the story. It's got lots of really good links in it. Sure. And here's a link to a prior story that you did on it. So there's lots to read there. Yeah. And also I want to give a shout out to YYC, who he's our market czar. He's a soothsayer. of the markets, and YYC just did a really nice rundown on the bear attack last year. So, I mean, I guess it makes for grim reading, but if you want to know like what happened in the markets last year, why did things go the way they did, please go to the Defiant website and check out YYC's rundown. He gets into the Fed, interest rate policy, collapse of Terra, DeFi tokens. I mean, YYC, it was like 5 years worth of market action in 1 year, wasn't it?
It really was. And to be honest, the Fed warned us right at the start. They said, all right, inflation is the problem. We have to take care of it. So, I mean, and every time they've gone on these aggressive hiking binges, risk assets have suffered in the past. So,
yeah,
indeed. I mean, but it was a long time ago. I mean, you guys weren't even born the last time they did this.
Yeah, at this space, yeah, probably not. But I mean, they tried to tighten back in 2015, 16, I think it was.
Yeah.
They tried, and then they're like, I think they gave up when the rates hit like 2.5% or something, because like markets really didn't like it. So
yeah, that's been just the biggest lesson for me this year. I mean, yeah, as someone who wasn't really alive, I think the last time interest rates were, I guess, 5% or almost. It's been amazing. The like unarguable degree to which heightened interest rates have changed market conditions has been a deep lesson. So
a deep lesson, and it's a reminder that the laws of economics do apply. And there was a time there when it was really after 2008 when there was that huge bout of quantitative easing, when the Fed was just buying mortgage bonds and trillions of dollars were being pumped into the financial system to stave off a global depression. And everybody was anticipating, that we're going to pay the price in inflation. And inflation didn't happen.
Yeah.
And so I was like, whoa, maybe we're in a post-inflation world or something. But the quantitative easing of the pandemic was different. And I mean, it was different in size, but it was also different in that all of that government largesse was not just going into the financial system, it was going into households. And that, I think that made a huge difference. And I mean, I know it sounds kind of weird to say so, but there is something comforting, I think, in the thought that, hey, if you flood the zone with this much money, there is going to be inflation, and it actually happened, because there's something comforting about the economic laws are still working,
Yeah.
It's also just it's like the degree to which everybody got used to the low rates is the most surprising thing to me, right? It's like 5% rates, like that was normal. Like not that long ago.
I know.
It's like the fact that that's like, like get your boot off my neck, like 5%. It's like
I know. Yeah. It's hard. It's going to be very hard for some time. But it is what it is, right, guys?
I always just final point on that. I mean, it is so ironic to me that like Bitcoin emerged like when rates plummeted to zero, and it kind of, I don't know, to me it's an irony of the crypto environment that Bitcoin was emerged when rates were really low and capital was cheap. And so I think it will be very interesting to see how crypto does, like when I don't know, the stakes are higher and money isn't sloshing around quite in the same way. And
under normal borrowing conditions.
Yes. And can it, it's kind of like this, it was made out of this rebellion of the financial system, but it was also buoyed by a tweak of a parameter of a financial system. So it'll be interesting.
Okay. Well, getting back to this week, I mean, not to go overboard on all the regulatory stuff, but I just want to flag, I mean, we don't have to discuss this, but it's just want to flag, this piece that Sam Hague did on the SEC and Binance. Voyager, a CeFi lender that went bankrupt last year in tandem with Three Arrows, the hedge fund. It was supposed to be bought out of bankruptcy by Binance's U.S. affiliate. And the SEC filed, they basically put a submission into the Voyager bankruptcy process, saying, whoa, hold on here. We don't think this Binance US entity should be allowed to buy Voyager. They're not providing enough details on how they could afford it. They use the word consummate the transaction, not enough details on how they would rebalance the crypto assets. Basically, they were kind of saying, we need to know a lot more about this before we're willing to sign off on it. And in Sam's story, he raised a really interesting point, which was that this could be kind of a suggestion. SEC almost seems to be suggesting that it doesn't really believe that Binance US is as separate from Binance, the parent, which is, of course, the number one cryptocurrency exchange in the world, that it purports to be. And so that's a clear warning shot to Binance writ large that SEC is not just going to like stand by and not challenge that Binance US is not a wholly owned subsidiary of Binance. And again, the main point here is that Binance US would enable Washington to take direct action against Binance itself, even though Binance is not domiciled here. So there's a kind of like kabuki going on with the regulators. They're kind of sending a message, I think, through this action. In addition to, I'm sure, having real good faith concerns about the wherewithal of Binance US to take on Voyager Digital, which would be $1 billion deal. It's not a small deal. So just wanted to kind of flag that one. And then finally, I think today we had some really interesting news, again, that Sam did in Asia on China reversing course on NFTs with a platform launch. I mean, YYC, you're an NFT master. Did this surprise you?
Not particularly. They've been talking about this for a while, but it's not really connected to NFTs as we know them. You know, it's their own closed system. You trade like it's only for like, I don't know, supported or approved IP and stuff like that. Whereas, I mean, they are NFTs, and they're using like this, I guess, a similar standard or whatnot, but it's not like what we expect NFTs to be, you know, like bearer tokens, anyone can buy them, openly traded.
So what's the point? Or is there no point to doing this? Is this just kind of like dead on arrival, or?
I mean, this could be a way for them to digitize, or like a step on the way to like digitizing copyrights and like making it more efficient to register IP and stuff, I guess. I haven't personally dived too much into it, so not sure.
Okay, so it's kind of a potential baby step that the Chinese government is doing. I mean, this is true to form too, is that the Chinese government usually comes out and is against everything. They're against Bitcoin mining. They're against exchanges. They're against it. And then they're like, well, okay, now that we've studied it for a little bit, as long as it's done under this hyper-controlled process, we'll be cool with it. But by being hyper-controlled, you don't have any market dynamics.
Yeah. Well, because I think it was notable because I think for tech giants in China, Tencent, Baidu, I might mess these up pronunciation-wise, and JD, I guess they self-imposed a ban on trading digital collectibles in mid-2022. So it also, I mean, Ed, it just kind of fills out the point you made, which is that, I mean, I think there's a certain degree of self-restriction or I don't know. And then now it's like, okay, we got to look at it. Let's try to roll this out again with a higher degree of control. So,
okay, cool. And meanwhile, I actually think this is potentially more interesting, right? So digital Hong Kong dollars. Now we've got a lawmaker. I mean, he's one member of a 90-member legislative council in the city-state, semi-autonomous city-state of Hong Kong. But he's basically turning to Beijing and saying, hey, we would like a green light to start, developing a central bank digital currency, which could be morphed into a stable coin, would also like something like a virtual asset rating agency. And again, this is all kind of being done to burnish Hong Kong as a Web3 locale, which is pretty interesting because given the baiting that crypto took last year, I would imagine a lot of metropolises are not going to be trumpeting themselves as crypto capitals. I mean, London has been doing that for years. I'd be surprised if they kept doing it this year. But there's a lot of action in Singapore. As Sam reported in his story, this initiative was motivated by a desire to compete with the likes of Singapore as an Asian hothouse for Web3 applications, Web3 development. And and Hong Kong's been going through just such a crucible these last few years in terms of civil rights, COVID, etc., that I guess it's not surprising to see entrepreneurs, Web3 entrepreneurs, trying to change the narrative.
Fair enough.
Yeah, and to be clear, Hong Kong, like China and a lot of other countries around the world, has already piloted a CBDC, and so this lawmaker is really calling for them to take the next step and actually bring it to fruition, because there are. I'm actually looking right now. The Atlantic Council has a CBDC tracker with a map of the world, and it shows the various stages of progress each country has made. And there are a lot of ones that are looking into it, that are working on it, that are piloting it, but only 11 countries around the world have actually launched one. So
fascinating. Okay. Yeah, I mean, that continues to be a rather vibrant front, right? I mean, I think even last year, amid all of the bear market and so forth, the Fed, European Central Bank, they keep plugging away on research into this. Bank of International Settlements in Basel has put out some very interesting papers on CBDCs, and I wouldn't be surprised if we saw some interesting stuff coming out of the World Economic Forum in Davos, which is week after next, on CBDCs. Yeah. All right. Well, quite a busy first week for 2023, and I think it's only going to get cranked up even more. Just want to thank you all for your stories this week and reporting. We look forward to what's coming next week. And thank you again, community members, for helping us develop the DeFi year 2022 stories and the Trends to Watch 2023 pieces that we also publish. Those are all available on the website if you want to check them out. And with that, I'm Eddie Robinson saying thanks. YYC Trader, Owen Furnow, Alex Gilbert. We'll see you next week.
All right, guys.
Cheers.
See ya.